Good afternoon, guys. My name is Gavin. Welcome to Alpha Chain's macro markets. That's where the focus is, looking at the macro themes ahead. Now, there is only one macro theme that the entire market is focused on. It's naturally the Russia and Ukraine situation, whether the invasion is going to happen, it's not going to happen, and it's going back and forth. There's a lot of hearsay, especially in sort of the media that we've seen from this morning. There was discussions of a meeting that was going to be taking place by Biden and Putin, but it seems like there was no. That's not confirmed. That's not confirmed. So we're hearing from Washington and we're hearing from Moscow, two different stories in regards to whether they will meet and have a discussion. So it seems like there is a lot of hearsay when it comes to the negotiations and whether there will be anything negotiated or even a meeting to occur with US President Biden and the premier of Russia, Vladimir Putin. Even though there was an informal discussion with French President Macron Sunday night, but still, whilst we have all this going on, there is an occurrence that's taking place on the border that we're not getting a lot of information, but we know there is whether it's an imminent war or an attack that's already taken place, there is something that's taking place on the border in certain parts on the Ukraine side. But again, markets are reacting to this. Right, there are a few slides that I want to cover with you guys. There are a few macro slides that I think we should have a look through before we come over to the charts. If you have questions, this is a live interactive session, so please do make your questions aware. Okay, so do type your questions in the chat. At the end of the session, I'll allow you guys to unmute yourself and ask questions. There's no issues with that either, but we'll do that at the end. In the meantime, if you have any pending questions, please put it in the chat room and I'll come on to them when I can. Okay, a quick overview of asset classes by year-to-date performance. Oil naturally is the outperforming asset within the commodity asset class. Well, not specifically commodity asset class. Well, that's probably sort of a mistake there. We know that there are some commodities that are really outperforming, potentially even, greater than the oil market. But if we're looking at the major macro markets and we're focusing on the most tradable assets, oil is certainly outperforming right now. So oil surpassing 20%, gold in the positive for the first time, and not just year to date, even from last year's performance. But gold is on the positive side. Year to date, we're up 3.8%. Dollar is also moving to the positive side as well, as we're seeing not only safe haven flows leading a little bit to the dollar strength, but also the upcoming Federal Reserve rate hikes to be expected, where some institutional banks such as Bank of America and Goldman Sachs have suggested 7 rate hikes is on the cards and on the table this year. Government bonds are in the negative territory. So remember, there's an inverse correlation between the bonds and their yields. Okay, so if yields are rising, therefore government bond prices are falling. And that's what we see here is government bonds down a negative 3.2%. Naturally, sort of the most riskiest of bonds are corporate bonds. So those are down 4.4%. And of course, investment grade bonds. Stocks are moving to the downside. Now, this is data from, I believe I took it from last week's close. So this is not taking any new information in, but as we can see, some of the equity markets are back at those lows that we were, or surpassed the lows from Friday. Bitcoin also down, negative, close enough to, well, just surpassing 12%. So Bitcoin is down 12%. Here's another chart. This is a little bit more intricate, as you can see. There's a lot more data on here, so we can sort of go through this. Now, okay, when we're looking at global stocks, okay, so we're looking at global stocks. on the top left corner. So we've got USA, US, and that's showing you the S&P 500, the SPY. That's showing you the price. Look at the 1 day change, look at the 5 day change, 30-day change, and year to date. So this is giving us breakdown over 4 different changes in percentage. And all the way through, it's quite negative. And if you look at throughout the list itself, it is the one that's showing the most sell-off that's occurred, or second most sell-off that's occurred, apart from China. China, with all the credit crisis that we're seeing, credit crunch taking place there, and a lot of these property firms have gone under. And there's also, from a political standpoint, a lot of concern there as well. But so far, you could see clearly that they've been underperforming substantially across the board. Who is faring the best at the moment? So it seems like, just going a little bit lower down the list, Mexico is performing slightly better. But overall, it's quite a negative view. It's quite a negative view for equity markets. Okay, so the vast majority of them are in the negative. Okay, leading the way is obviously the US and China, and then of course you've got Japan in the negative there as well. Europe's in the negative, Germany as well, UK as well. UK is actually faring slightly better in comparison to most of the G8 currencies that we can see over there, the countries that we can see. Yeah, so. Switching it down to the global macro, so now we're focusing more on asset classes, not just.
News from Russia coming via the RIA news website says explosions reported near the Donetsk airport.
Okay, it seems like
that's coming from an RIA news correspondent tweeting explosions near the airport in Donetsk.
Okay, the war is certainly ramping up. Okay, so moving to global macros, right? So you got the S&P 500, right, underperforming, but look at the US Treasury 20-year bond. 20-year bond, the longer sort of the 30-day and the year-to-date is underperforming, but the most recent is doing well. Why is the most recent doing well? Well, naturally, bonds will sort of do well when assets are moving to safe havens. Okay, so when it goes to from risk on to risk off situation, as we're seeing right now, US dollar index. That's doing okay so far. Year to date, all the way through is positive. WTI oil is outperforming, as we are already aware of. Gold is also faring much better than usual. Also, commodities. Just looking at the commodities, that's doing quite well there. At the bottom is where you have 2 crypto assets. You've got Bitcoin and Ethereum. Both are underperforming from a global macro standpoint. Moving on to sectors. So we're looking at, generally there's 11 key sectors that you would look at in the S&P 500. So we've got the S&P 500, NASDAQ, Russell, and then you've got the key sectors on there. It seems like the energy market is the only sector that's actually outperforming. The energy market is outperforming. So yeah, commodities are still in focus. Okay, and then smart beta. Smart beta is looking at different types of trading styles or investment styles. Okay, so you got an equally weighted S&P 500. So the constituents of the S&P 500 all given an equal portion and percentage or allocation. How is that faring against just the mega caps or the large caps, mid caps, small caps, micro caps? Then you've got other types of beta types of strategies, which are momentum, high volatility, growth, high beta, quality, value, low beta. So yep, so you can see sort of, where the focus is. And a lot of the most recent discussions have been growth versus value. Okay, so growth versus value. So just have a look at growth, right? So growth overall, I mean, year to date, it's down 13.5% or just over 13.5%. 30-day change, 4% down. 5-day change, nearly sort of 4.61% there. So a fall of 4.61%. But if you look at value is actually not that bad. Year to date, it's only down 3%. So overall, there is selling pressure taking place, but not as much selling pressure in comparison to growth stocks or momentum stocks. Momentum stocks are also faring the brunt of this, the risk-off flows. So yeah, this is the asset class summary overall. Something else to be concerned, well, not can be concerned about, something else that has been trending very well is gold. So if you look at oil's performance. Now we're looking at gold. Gold is actually outperforming, right? And it looks like gold has taken over oil as the main war hedge. But please don't forget that gold is also a bet on central banks messing it up. So messing up. So if the institutions and the market participants are expecting 7 rate hikes to occur, is that likely to happen? Is that going to happen? And it seems from the meeting minutes that was received from the Fed last week, Wednesday evening, 7 p.m. UK time, it didn't seem as hawkish as previously expected. So there's been a little bit of a retracement in the view of very aggressive rate hikes of 50 basis points to be expected in the upcoming meeting. I believe it's on the 16th of March. But gold is the one that's outperforming. It's doing well against the geopolitical backdrop that we've seen. But most certainly, you've got to be mindful of the other side of the coin, which is obviously inflation and how central banks are reacting and what they're likely to do in regards to their forward guidance. This is something that I picked up from the Bank of America's. This is their fund manager survey that they carry out on an ongoing basis. Okay, and what this is showing us, this is almost like a timeline from 2011, so July 2011. We could see. Let me just do a full screen there. So from I believe, so July of 2011 through to Jan of this year, 2022, you can see sort of the theme at play. Okay, what has been that theme? So in 2011, a lot of the issues that were concerning the markets were around the EU sovereign debt funding. Okay. There was even a possibility of at that time, I believe, was Italy government defaulting at that point. There, one of their oldest banks had to be shut down. So yeah, this is going back to sort of 2011, 2012, and then moving on from there, from 2013, US fiscal cliff, and then we go into China hard landing. Then we had other geopolitical crises during sort of 2015. Again, China hard landing in latter part of 2015 to early 2016. Then populism, rising of populism was sort of a key theme between 16 and 17. Then coming into 18, we had quantitative tightening. And this is where the Fed, the ECB, a lot of these major central banks were beginning to tighten substantially. And then coming into more political risk with trade wars, with Donald Trump sort of the face of the trade wars in 19 and 20. Latter part of 2020, obviously, was the US presidential election taking place. And then, of course, the pandemic, the coronavirus pandemic. And of course, now where we are at the moment, which is the inflation concerns. Okay, the inflation concern at this moment. I'm pretty much seeing that, that's probably subsided a little now, purely because the focus is going to be now with the Russian situation. And here's something else that was part of that same research document, that survey. Now, the percentages certainly has changed, in my opinion, but this is just showing you what are the biggest tail risks in February 2022. This might be, in my opinion, a little bit outdated, but it's showing you the top key themes, right? And we're just gonna, don't put too much emphasis on the percentage. We can sort of adjust that to how we see the markets, but these are the 7 sort of key themes at play at this moment. So naturally, the first one and the most important one is central banks and their rate hikes, their hawkish view and their expected rate hikes. Clearly, that's being driven by inflation, right? So, inflation concerns is a key point there. Asset bubbles, are there asset bubbles in certain sectors? It seems like part of the fund manager surveys, 11% of them believe that there are pockets of bubbles, asset bubbles within, whether some say is probably the crypto markets. A global recession, again, 8% of those fund managers has voted for a global recession. Is likely one of the key tail risks. Of course, the growing and the imminent, it seems, Russia-Ukraine conflict. COVID-19 is only 4%. LTCM-like credit event. Right? So we saw the bubble burst when it comes to Evergrande over in China. The property developer had gone in significant into a default. It's still on the verge. It seems like they may have secured some government funding, but we saw something very similar occurring in China in regards to a credit event likely to have a knock-on impact on the rest of the economy, global economy. But the likelihood of that is 3%. Okay, this was something that was key and mostly in focus in December of 2021, coming into Jan of 2022, but it's been in the background since. Where I see the focus now is number 5, Russia-Ukraine conflict. That comes to number 1. Then number 2 will be inflation, and number 3 is the hawkish central bank hikes. Yeah, I mean, those are my top 4. That will be my top 4. Asset bubbles, again, there's we're at all-time highs. Well, we were at all-time highs. We see markets still are sort of on a little bit topsy at the top end, sort of, but we're seeing a bit more of a correction occurring now. So I don't see that there's going to be a global recession from this, but I could see definitely we see a correction. And a correction is generally what I'm looking for is 3 negative GDPs, okay? 3 negative GDPs in regards to a correction. But from a technical standpoint, it's a 20% from the high, the most recent high. Okay, oil prices. So this is something that was taken from JP Morgan, their macro research team. So the risk profile is asymmetric given the underlying tightness of oil markets. A de-escalation of tensions with Russia and a successful resolution of the Iran deal should push oil prices down towards our sort of $86 per barrel. That's the estimated of their fair value. That's the estimates of their fair value. But as I mentioned, a confrontation that disrupts Russia's supply has a potential to push oil prices much higher. So we could be looking at 100 to even 120 barrels a barrel of oil. Now, 120 seems a very sort of, far end as prices are around now 92.20, 92 spot 20. But we could see $100 a barrel if we see what we're seeing or hearing now continue. Okay, and we're coming back to sort of the one of the sort of key things that I mentioned a little bit earlier, and that was the sector rotation from out of growth stocks into value stocks. Now that has been a key theme where, especially in times of uncertainty, when there is uncertainty in the markets, you'll often see markets either first rotate into value assets, rotate into assets that have a very strong balance sheet, a strong fundamentals, strong management. But not only that, then the worst case scenario is then they move into sort of safe havens when there's a lot of panic. It seems like we're on that verge now where we've gone from very optimistic view, growth, looking for growth sectors and a lot of risk in the markets for the rewards and the returns. We've gone into something that's a bit more value play, where we're looking at quality of assets, companies that have a good cash flow and cash reserves that are have a good team, a good management, and so, rather than going to some small cap stocks that are that have a high run rate and have a lot of debt on their balance sheet. But then at the same time, we're on that fence now where it could now go down to where we see more of a larger correction taking place, and a lot of the safe haven assets are going to outperform in times of when there's potentially a war that could occur. So I remember showing this to you some time ago where we saw one of the most where a substantial amount of money flows went into one of the key growth ETFs, which was the Cathie Wood's ARK Innovation Fund. That had corrected substantially. We've seen a substantial correction in that, and we're seeing a lot more demand in Berkshire Hathaway, more of a value play. But let's just have a quick look at this next graph here. So this is still the red line. You can see the red line is ARK Innovation ETF. Okay, so ARK Innovation ETF. And then over that, we have what we tend to see is the ebbs and flows in market sentiment or psychological aspect of trading the markets. So you have the stealth phase, the awareness phase, the mania phase, and then the blow off phase. Those are the 4 key phases there. Now, what happens in the stealth phase is the market begins to take off. The market's beginning to really do well in the current market condition, the current climate. And then as that proceeds to move higher and it breaks those prior highs, we're starting to see we're transitioning onto the awareness phase. So there might be a little bit of a dip that takes place, but then that dip allows a lot more buyers and a lot more other investors to get involved in this particular asset or asset class. So that's where we see the next level of awareness taking place, where it starts to make very strong flows, very strong sort of directional plays. The gradient is more steeper to the upside. And then it goes into mania phase. That's when the media starts to broadcast a lot more information, and then there's more enthusiasm that comes into the market. Then it's greed, and then delusion, potentially at those lofty valuations at those really high ends there. And then it comes to a point where it cannot go in one direction for entirely. Okay, it's not going to go only in one direction. At some point, we're going to see a correction occurring. But unfortunately, because of the move that's already occurred, the gradient that we've seen, the excessive aggression in those buyers can lead to a much larger correction occurring. So that's when we have the first move lower. We have that first move lower, the markets then pull back, and it seems like, okay, that was the buy and the dip opportunity, but nope, it's not quite that yet. So almost a dead cat bounce occurrence there. And then we have the next new lows. And that's when it goes from anyone that was at these lows. That's what we're going to look for. We're going to look for consolidation at these lows now. That's what you want to see, is consolidation in this range here now, because we've gone from a denial, then return to normal, or a buy the dip opportunity, and then it breaks and makes a new low, and that's where fear steps in. Fear steps in, people are starting to cut their positions or getting stopped out, and then it's capitulation, and then pretty much despair is when everyone's out of it now, okay? And that's where you see a balance coming into the market, and then a bit more balance between those buyers and sellers, where buyers may start to sort of, buy into this asset, and new money or new flows begin to accumulate this particular asset. So just be mindful that when you trade an asset, and an asset's moved substantially in a very short period of time, it doesn't have to be just hours or days. It could be weeks and months. And if you see that occurring, just be mindful of how much you want to allocate to an asset that's moved already a certain amount. Okay.